In a world of ever-changing financial landscapes, how do you navigate the chaos?
Join top analysts like Joseph Wang, Lacy Hunt, and Emily Brown as they break down today's markets.
We've distilled their crucial insights into AI-generated summaries, saving you time and delivering the knowledge you need.
Get ready to dive deep into the trends that could shape your investment strategies.
Today we're looking into Joseph Wang's analysis regarding the current dynamics of equity markets.
His insights explore potential corrections and the various factors that influence market volatility.
Joseph mentions that equity markets may encounter significant corrections.
This viewpoint is supported by rising volatility trends and investor caution. Joseph suggests observing volatility indexes as key market sentiment indicators.
He points out that trading volume spikes can indicate heightened market activity. Joseph highlights that global economic elements are significant for U.S. equity markets.
He emphasizes trade relations and policies as important in market dynamics.
What market corrections does Joseph envision?
Joseph forecasts potential corrections around 10 to 20% as market volatility continues. Joseph concludes that a diversified portfolio is vital in uncertain market conditions.
He stresses the importance of tracking economic indicators and being ready to adapt investment strategies. Today, we're unpacking the economic analysis presented by Lacy Hunt, discussed in conversation with Adam Taggart.
Hunt's insights focus on the critical state of the economy and the Federal Reserve's need for urgent action.
Lacy Hunt emphasizes that crucial economic indicators are raising alarms, yet the Fed's response remains cautious.
This leaves investors anxious about the implications of inaction, especially with signs of economic stagnation. Hunt points out that many economic indicators suggest a deteriorating environment, but the Fed's actions have not matched this urgency.
It's concerning for investors who are trying to navigate these uncertain waters. Lacy Hunt expresses that investor confidence is dwindling due to the Fed's indecisive stance.
He suggests that investors should consider adjusting their strategies to mitigate potential market volatility.
What does Lacy Hunt predict if current policies continue unchecked?
Hunt warns that prolonged inaction could lead to a significant slowdown in economic growth, affecting various sectors.
In conclusion, Lacy Hunt advises that investors should stay alert and be ready to adjust their strategies based on economic developments.
He stresses the importance of focusing on sound financial strategies to navigate potential challenges that lie ahead.
Welcome, everyone. Today we are exploring the housing market with insights from Emily Brown.
Emily will discuss how rising interest rates are affecting buyer sentiment.
Emily points out that increasing interest rates are significantly influencing buyer habits.
She notes that many potential buyers are pausing their plans, which might threaten home prices.
David emphasizes that the housing supply issues could keep prices stable in a softening market.
Emily argues that the increase in mortgage rates is reshaping the home buying landscape.
How does this specifically affect the buyers, Emily?
She notes that buyers may be choosing to hold off until they see a clearer direction in the market.
What future trends does Emily foresee?
Emily predicts that continued low buyer interest could lead to price corrections, though supply issues might limit extreme changes.
Emily underscores the need for homebuyers to stay updated on interest rates.
She advises keeping track of the housing supply as an important market indicator.
Welcome to Eurodollar University. Today, we'll analyze recent developments in the jobs market and potential Federal Reserve actions.
There's growing concern that if job numbers worsen significantly, the Fed might need to consider a 50 basis point cut in interest rates.
Today's discussion suggests that if the jobs market doesn't improve, significant cuts to interest rates could be on the table.
Experts are increasingly anxious, indicating that maintaining job stability is crucial for a healthy economy.
Analysis reveals troubling trends in the labor market that could force the Fed into action.
Indeed, these trends not only impact consumer spending, but also undermine overall economic confidence.
While a 50 basis point reduction may offer some immediate relief, it could lead to challenging long-term consequences.
As discussed, these cuts often introduce inflationary pressures that complicate real GDP growth.
If job market conditions don't improve, we may face ongoing instability in economic performance.
Such uncertainty highlights the need for vigilance in labor statistics to identify shifts
There's a real possibility that we could see interest rate cuts in response to declining employment figures.
The Federal Reserve may need to act swiftly to stabilize the economy, given these conditions.
In conclusion, staying abreast of the Fed's potential moves is essential as we navigate these uncertain economic waters.
An understanding of how employment conditions influence policy can assist investors and individuals in making better informed choices.
Welcome to Trade Brigade. Today, we'll be looking at the recent developments around tariffs with Reed Taylor.
Reed, what are the primary implications we should consider?
Reed will elaborate on the legal landscape surrounding these tariffs.
What legal changes have been identified? Reed warns investors about the instability that follows tariff changes.
That makes sense. How should investors react?
Uncertainty in trade policies often results in swings in market confidence.
Reed emphasizes the toll changes may take on global trade.
Exactly, and businesses will need to adapt swiftly.
What does Reed foresee for the markets ahead?
Reed predicts continuing volatility for the next few months, suggesting that investors exercise caution.
Reed stresses the importance for investors to reassess their portfolios.
Being attuned to trade agreements and laws is essential for smart investing.
Today, we're discussing the complex landscape of global conflict with insights from Trita Parsi.
Trita highlights the urgent need for strategic diplomatic approaches.
Trita Parsi identifies that tensions are at critical levels, indicating potential for conflict.
He stresses the necessity of immediate diplomatic interventions. Trita notes that the geopolitical landscape is rapidly changing, necessitating a reevaluation of U.S. policy.
This underscores the need for adaptive strategies. Trita emphasizes the importance of dialogue in conflict resolution.
Engaging global leaders can help reduce hostility and promote peace.
What implications does Trita foresee for U.S. engagement?
He warns that sidelining diplomacy could propel military conflicts by year-end.
In conclusion, Trita Parsi reiterates that U.S. diplomacy must be prioritized to navigate rising global conflict risks.
He advocates for strategic engagement with allies to foster stability.
What an incredible range of insights we had today.
Definitely. Trita Parsi's emphasis on diplomacy reminded us how critical those strategies are in avoiding conflict.
Right? And Reed Taylor highlighted the ongoing impact of tariff changes on market stability.
Exactly. And it seems we can't ignore the implications of Federal Reserve policies. Economic analysts and Lacy Hunt both echoed that sentiment.
It's fascinating how they converge on the importance of Fed actions, yet disagree on urgency. Hunt feels they need to act decisively, while the analysts see a more cautious approach.
Couldn't agree more. And then there's Emily Brown, who brought a fresh perspective on the housing market amidst rising interest rates.
Yes, the discussion around buyer sentiment being affected by economic shifts really added depth.
And who could overlook Joseph Wang's insights on market volatility? He's definitely raising the alarm for investors to stay alert.
Feeling informed yet? If you found these perspectives as enlightening as I did, give us a thumbs up.
Don't forget to subscribe for more critical analyses and expert insights. There's so much more to explore.
Absolutely. Join us again as we delve into more economic currents next time. You won't want to miss it.